Welcome to Commercial Real Estate Now, live from the floor of ICSC Las Vegas PropTech Conference. I'm your host, Carey, Iacono, and I'm so pleased to be joined by Gino Sabatini, Head of Investments at WP Carey. Gino, welcome to Vegas. How are you?
Thanks, Carey. I'm so excited to be on your podcast. I've been watching it for years.
About time. I've been trying to get you on for years, but we had to do this whole setup. We had to go wait for Vegas. So I'm glad it worked out. Glad we can have this conversation.
It's great.
So today we're going to have a conversation not just about the strategy of retail for WP Carey, but really what makes retail a durable, good investment in this marketplace. And, we talk to investors all day, and there's a lot of theories on what it means stability in retail. So very excited to hear your perspective on it. Before we jump in, why don't you take a moment and just tell our listeners a little bit about yourself and WP Carey?
Sure. Again, my name is Gino Sabatini. I'm head of investments at WP Carey. We're a public REIT. We've been around since 1973. We're traded on the New York Stock Exchange. And I would say we are the second largest public REIT that focuses on triple net leased products. We operate in 22 countries around the world. We focus on most property types. We stopped investing in office. I think we'll get into that a few years ago, but we're big into industrial. We're big into retail, both in the US and Europe. And we also do specialty types of buildings like food manufacturing and R&D, things like that. So that's our focus. I've been with the firm 26 years. I've been in a similar role for that whole time, originally going out and finding investments, structuring them. Up until about 2012, we were borrowing at the asset level, so we would have to go out and source the asset level debt, and then get the transaction closed and on the books. So now I lead a team of approximately 20 people. We have a group in London that sources all of our investments in Europe. We have a team in New York that focuses on the United States. And I actually sit in Dallas, where we have a smaller team that I work with. So that's what I do.
So I'd love to go country by country, but I think for purposes of today, we're going to have to just keep to US, but it'd be pretty fun to hear what the thesis is in other countries.
Sure.
So next
some other day.
Yeah, exactly. Phase two, part two. And I think what's interesting about what you just said is how broad net lease is. And a lot of clients who are not in this space deeply just think it's a 7-Eleven, right? It's a Starbucks. There's nothing else beyond it. But everything you just mentioned is still within that net lease sphere, which makes it such an interesting asset type to focus on.
True.
Yeah. Okay, so let's dive in. Two sentences. I'm limiting you to two sentences or less of WP Carey's overall investment thesis.
We're looking for real estate that is critical to the tenant in one way or another.
That was very good. You were practicing that, I think, right? So what does that mean for retail? What does mission critical mean to you for retail in 2026? Sure.
Mission critical for retail, if I had to pick a singular characteristic, it would be rent coverage. Which stores cover very well. And we look at that in every single retail deal that we do. It's very important to us. So, there's many different ways to evaluate a net lease deal. You can look at rent per square foot. You can look at volume, sales volumes, et cetera. But for us, how profitable is that location? And how many times could they afford to pay us rent?
Right. And do you have different coverage ratios for different uses within retail, or do you just have a standard coverage ratio across a portfolio that is just a key metric in investment committee that you won't go below?
I would say it does vary somewhat by property type, but in general, we're looking for coverages of at least 2.5 times. But for certain specialty types of properties, say a specialty gym or a very high basis retail concept, we would want to make sure our coverage is even a little better, because we're taking more risk on the real estate with higher bases or higher rents.
So would you say that you put the coverage ratio higher I guess, in the security matrix than the guarantee on the lease, or do they both kind of play together?
They definitely play together, and it becomes especially important if you have a very long lease or if you have a master lease,
Right.
or if you don't. So if we have a very good credit, you mentioned 7-Eleven, on a very long lease, the coverage is less important because we can rely on that credit
Right.
to pay us the cash flow for the full term of the lease. But if you have a weaker credit, if you have a more specialized type of building, the coverage itself in each location becomes more important.
And do you ever buy anything without unit level coverage?
I guess never say never, but it's highly unusual.
I have some ideas for you then after. Never say never. I have a whole book of listings. I'll show you after.
Okay, perfect.
So what has changed? We've gone through a big evolution, COVID, everyone's tired of talking about it, but there's been a lot of change in retail. So what is something that you bought in 2019 or before that you would not touch today? What's changed?
Sure. Well, I can bring up an easy example that everyone can relate to, and that's Walgreens. We purchased 7 Walgreens. They were on long leases. They were, I think, 17 years. This is back about 10 years ago now, 9 years ago. And at the time, I think we and everyone else thought that Walgreens is a concept that is never going to go away. You need to go to that store to pick up your prescriptions. And while you're there, you're going to pick up a few things that you overpay for. But as you know, as well as anyone, the business model has changed dramatically for these drugstores. So that is not something we would do today. They worked out for us. We ended up selling them. But yeah, I mean, when we look at various retail concepts, car washes, I think, are a good example. You have a type of property that you'll have a difficult time doing something else with. So how durable do we think the car wash concept is? I would argue it's very durable.
Right.
People are going to be washing cars regardless of if they're battery powered or gasoline powered forever.
But how often? Right. And how many do you need?
All those things.
But yes.
We'll get all that is part of the underwriting.
Right.
But the concept in general, no one can see around every corner 20 years down the road. And Walgreens, I think, is a good example of a concept that just 10 years ago, no one thought was going to have a problem moving forward.
The gold standard. We're not alone in this thesis. Yeah.
And they were getting away with things, and we don't have to go into that too deeply, but their leases, they were getting away with things that nobody else would get away with because they were the gold standard.
Yeah.
And times have changed, obviously.
All right. So no drugstores in your future. I'm glad you were able to exit and pivot. So what is a deal that you recently did that you are excited about? What do you feel is a durable category of net lease?
Well, we've been excited with fitness centers for a long time. We did a lifetime sale leaseback in 2002. It was our first experience with Lifetime. We bought a gym in Scottsdale, Arizona, and one in Columbia, Maryland. And we also have worked with the company over many years, repositioning some other gyms that we owned in Minnesota. And we've always been super impressed by Lifetime Fitness. We recently did a deal in December. We purchased 10 existing leases from Angelo Gordon, 10 existing Lifetime stores at $30 million a pop. And we're super excited by the concept because we don't think that it's something that will change dramatically over the next 15 or 20 years. It seems to be a super durable product.
Are you one of their bigger landlords now? I feel like that's a pretty significant $300 million tranche.
Yeah, that was 330, and then we own 2 others. So we probably own 380 worth of Lifetimes. I would guess we're one of their larger landlords. I'm not really sure.
Hopefully you don't have to find out. You don't need to talk to them that much and everything's cool.
Yeah, we have a good relationship with them. They have a management team that's been there for a long time. They're a great group of people. Eric Buss was on the first deal that we did in 2002. He's still there. Bahram is a CEO that if you haven't heard of him, you should look him up because he is really an industry trendsetter. I mean, what he has done in the fitness industry no one else has been able to replicate. He's made an experience for, people who like to go to the gym just,
it's a country club of gyms.
It is. It's like an inexpensive country club.
Yeah.
You have people who will watch your children while you work out. Yep. You can go to the indoor pool, the outdoor pool. They have a bar, I think, in some of them. I mean, they're amazing places. So that to us seems like a very durable concept.
How do you feel about backfill risk, right? Because that's a specialty use building if there ever was one. You have a pool, you have all these rooms built out. I mean, I can think of nothing else that could be.
Okay, so interesting. That's a great question. And when we did our first deal in '02, that was a question everyone asked us. And at the time, as I mentioned earlier, we used to put asset level debt on all of our deals. So we had to convince a lender that there was an alternative use for these Lifetime Fitnesses. Sure enough, Bahram, in his genius, came up with a plan, and he had an architect do a study on how to convert a Lifetime Fitness into a 2-story suburban office building. If you look at a Lifetime Fitness from the outside, it kind of looks like a really good-looking 2-story office building. Oftentimes, they're in places where that building would actually make sense as an office building. So we had a conversion study done, and we presented it to the lender. At the time, it was $5 million to fill in the swimming pools, put a second deck through the basketball court, and the lenders bought off on it, and it was great.
Wow.
Now, as of today,
I don't know about today.
Yeah,
You tell them suburban office, and they're like, "That's not a real option."
Exactly. So I don't know
what you're really going to do with it.
There's really no conversion strategy today. They need to continue to work, and we think they will. They're terrific concepts.
So this is a story where you believe in the operator, you believe in the concept. I'm sure the financials are good.
Site level coverage.
Yeah,
again, that was the key to the whole deal for us, was that we have site level numbers in these 10 stores we just purchased. They cover very, very well, and our basis is low, and we're confident that they're going to stay.
Excited for you. Seems like a good transaction.
Great deal.
So net lease historically is a spread business, right?
Yep.
Over interest rates. And we're obviously in a higher rate environment. I mean, not that high if you look at it over a longer period of time, but certainly higher than we were 3-4 years ago. How are you getting deals to pencil now? Are you finding mostly sale leasebacks where your entry cap rate is higher, or are you compressing the spread that you're willing to accept? Like, how has your underwriting changed given where interest rates are?
Sure. Well, there's a floor to how tight the spread can get for us. We have a cost of capital like every other investment firm out there. Our cost of capital is fairly public. We're a public company. Everyone knows where our stock price is and basically where we can issue debt at. So we have a cost of capital that we need to generate a spread over. And we've been able to do that, I think, very successfully in all sorts of interest rate environments. It's just a spread business, as you said. And the types of tenants and clients that we go after are usually not investment grade. So they don't have the same access to the capital markets that, say, a 7-Eleven does.
Right.
So that spread will always be there for those types of tenants, and we just adjust our spread accordingly.
Okay. So you're making it work by the types of tenants that you're going after, the basis you're able to go in, and then you're a more attractive source of capital for sale leasebacks than public markets.
Exactly.
Yeah. All right. Makes sense. So all of that said, you're not positioning WP Carey as a retail REIT, although obviously you have a great retail strategy and you own retail. How do you look at overall portfolio construction and diversification?
We don't have set targets. I would say, the majority of our portfolio is not retail. The majority of it is industrial manufacturing, because that's kind of what we had grown up doing over a long period of time. We've been in retail in Europe for about 20 years. The US, it's somewhat of a new thing for us. We've been going heavy the last 5 years in retail. We've done about 200 mil of Dollar Generals. We've done over 100 mil of car washes. Lifetime, like I said, we're close to 400 mil on those. So we're trying to be more aggressive on the retail strategies in the US, and we really like what we've been seeing. So we've been able to, our target, frankly, is 300 to 500 mil a year of retail in the US.
So a well-balanced, diversified net lease REIT.
Absolutely. Our total target this year is between 1.5 and 1.75 billion of total volume. And, out of that, probably 30% will be retail.
That's what I like to hear. So as we're talking about diversification, you did make a very public, very strategic move to exit office in a spectacular spinoff that I think worked out beautifully for you. So tell us a little bit about the mindset when you decided to spin off that part of the portfolio and how that's worked out for you.
Sure. Well, the mindset was really a reaction to a constant problem we had been having for years, which was having to talk about the capital we had to invest in repositioning office buildings that had long leases that were expiring. So we decided to rip the Band-Aid off a few years ago and spin off all of our office buildings into a different publicly traded company. And that was actually the top performing REIT stock of 2024. We IPO'd. It wasn't an IPO, actually. We gave each existing WP Carey shareholder a fraction of a share of NLOP. So it was like a SpinCo. But the original trading price of the SpinCo was around $10 a share, and it went up to the mid 30s.
So why do you think that was? We're not going to speculate on the markets too much, but I mean, that's a huge jump for all of us.
Yeah, it was pretty simple. I think people who were able to put a spreadsheet together and add up the amount of rent that was due to come in from the tenants,
right,
even if you put a zero on the end and say that office buildings are worth nothing,
right,
it still added up to the low 30s per share. So people, hedge funds made a lot of money. They could put together a spreadsheet and say, wow, all the rent they have coming in from really good credit tenants adds up to $29.50 a share. We should buy this at 11.
Right.
So yeah, a lot of people made a lot of money. Just one more thing on office though. We actually we haven't purchased office buildings in scale since about 2015.
Oh wow, you were ahead of the curve.
Yeah, but it wasn't
before COVID.
We didn't obviously see COVID coming.
Of course, right.
We weren't smarter than anyone else. What ended up happening was we started modeling our CapEx and TI assumptions at the end of the lease term to be more reflective of what we were experiencing, which was something in the 70s or $80 per foot. And that required us to bid at cap rates that were no longer competitive. We were having to
priced out.
We got priced out.
Yeah.
The deal would trade at a 7 cap and we're like, well, we need to go in at an 8 cap to get enough cash flow to make that $90 a foot at the end make any sense.
Right.
So we started losing these deals, not intentionally, but just based on our own experience of underwriting.
Yeah.
And that was kind of lucky that we stopped buying when we did, to be honest.
I mean, that was a pivotal moment, really, because I don't see a lot of investors properly allocate the TI dollars, right, especially for office. And it's so much more than people realize. So that was very smart moment.
Well, we have a bit of a different mentality where we plan on holding something until the lease expires. So if other investors may think, okay, I'm going to hold this for 5 years, flip it with 15 years remaining. So you don't need to worry about those TI dollars then.
Unless your tenant vacates when you're not expecting.
True.
Now, right? Okay, that happens.
That's true. Those things can happen.
Should be probably modeled in a little more than it is across the board, but
agreed.
But you were smart to model that in early.
Better lucky than smart. It worked out.
And then you probably look like a genius come COVID. Yeah. Everyone was like, wow, they haven't been buying office. They're brilliant, right?
Yeah, it worked out. So the SpinCo worked out. Everything seemed to work out well. So we're happy with that.
Congrats.
Thanks.
Where are you finding opportunity moving forward? Like, what does the rest of the year look like for you? Is it geography? Is it asset type? Like, what are you bullish on in terms of the next 6 months?
Well, we're seeing a lot of activity with private equity firms. We just closed 10 days ago, one of our largest deals ever. It was a $400 million sale leaseback with a company that makes mulch. So if you walk into a Home Depot and purchase a bag of mulch for $3, it's normally manufactured nearby from recycled trees and things like that. So we're seeing a lot of activity from private equity firms. That was done in conjunction with the private equity firm's buyout of that company. And we were brought in at the closing table as acquisition financing.
How is the credit and the guarantee on something like that?
Well, it's a private equity credit.
Okay.
And,
so you were comfortable with that?
We've been comfortable with private equity credits since we worked with Bill Gibson on his take private of Gibson greeting cards, which was, I think, in 1982. So I want to say more than half of our business comes from private equity firms or is done in conjunction with buyouts of one form or another.
So you're comfortable navigating that space because there's some ups and downs to private equity, but it sounds like you've found the right partners.
Comes back to criticality, like we were saying before. Our belief is even if, you get involved with a PE deal that maybe is over levered and they have to restructure the balance sheet. If you have critical assets on a tight master lease, that you're basically the number one creditor, and they have to, how bankruptcy works, you have to affirm or reject.
Right.
So our belief is, and our experience has been, that odds are they affirm that critical master lease and you emerge from the bankruptcy in a stronger position.
So I have to ask you directly, what do you think makes retail mission critical? Is it a box? Is it proximity to the consumer? Is it something that can't go online? Is it coverage ratios, which can change?
Yes.
Right. So what one factor do you think really determines if something's mission critical or not?
Again, it would come back to coverage.
It would. Okay.
I think that's, if you want to pick one word to determine criticality in retail, it would be coverage. You can go into everything else. You have an irreplaceable hard corner. You have, just amazing cell phone data. You have, there's a lot of other factors you can look at that are also important. And maybe if the coverage is a little lower, those things become more of a factor.
Right.
But if it's one thing, it would be coverage.
Okay. Summed it up for us. That's what we all need to focus on. Any parting words or thoughts for the rest of the year?
No, we're super excited. We've announced, our volume so far year to date, and we think we're set up to have a terrific year. So I would encourage any brokers out there who have a deal they want to show us to feel free to give Carly a call or give me a call, and we'd love to take a look at your deal.
I'm very excited for you for what's to come. Obviously, WP Carey continues to innovate and has been very successful. So much luck to you for the rest of the year. I'm sure it will be a great one.
Thanks, Carly. Greatly appreciate it.
And thank you for joining me in ICSC Las Vegas. And for everyone listening, that was this episode of Commercial Real Estate Now, live from the ICSC PropTech floor. We're so happy you tuned in, and we look forward to seeing you again very soon. Have a great day, everyone. Thanks again, Gino.
Thank you.